Oh, brother.
The world's largest casino, aka the old stonk market, is looking quite frothy. Here we are going into the final trading week of the month of August, and we are this far away from an all-time high, but the story of how we got here is even crazier. Pretty much for the past week and a half, we've been slowly and surely grinding down and down and down, and then just like that, bada bing, bada boom, Chair Powell had some commentary on Friday, and the markets absolutely exploded, and even though we didn't hit record highs, like I said, we were very close. So of course in this video, I'll be breaking down what happened on Friday and why everything changed so dramatically, but most importantly, I want to be talking about this idea of, are we going to be hitting a new all-time high, which yes, I do believe is likely, but I think the most important question is, do we have a chance of really sustaining the movement past that? We got a lot to get into, but before we do that, if you haven't already, don't forget to like, subscribe, turn on your notifications. It very much helps me out. Obviously, love having you guys around here. With that being said, let's rock. When the market officially closed on Friday, ushering in the weekend and giving us the opportunity to count all the tennies we made off the amazing day, here was the official headline. Dow surges more than 800 points to post record close as Powell's speech fuels rally. So of course I'll be getting into that, but just to give you some larger context, here's the daily chart of the overall S&P 500. And even though we didn't hit a new all-time high, we got very, very close. Overall, price structure strong, higher highs, higher lows, momentum is strong. We're on top of all the EMAs. Things are looking pretty darn bullish, and that's also true in the Nasdaq. Granted, we're a little bit farther away from the all-time high, but overall the same structure, and one that has a very different structure, but still now bullish, is the small cap world. The Russell 2000 right here, nice technical breakout, huge gain on the week. Friday alone up 3.8%, looking pretty good there. The following one, I need to talk about Bitcoin, and I want to get into this, that yeah, it broke out on Friday, but obviously trading over the weekend, we're now starting to see a little bit of weakness. So great follow through on the week, great double bottom recovery here. Overall, a little bit more choppy. I really did want it to hold above the 50 EMA. I wanted it to hold above this down sloping trend line. Saturday, Sunday hasn't been so promising, but obviously let's see how things play out when the market really gets going this upcoming week. So that's the larger picture. Equities are looking pretty darn good. Bitcoin was looking good. Crypto was looking good. It's losing a little bit of its footing over the weekend, but once again, it's just the weekend. Now, if we dive into what really happened on Friday, it's pretty evident around 10 a.m., right when Jerome Powell started to speak, the markets all just exploded. Ripped and ripped and ripped. You see that in the SPY, you see that in the Qs, you see that in the Russell. A lot of these individual equities looking super good, huge gains, and it's not just the tech sector. Look at this. This is the heat map of the S&P 500. You almost have to put on green tinted sunglasses because there is a lot of neon green. And why did this all happen specifically on Friday? Why are we now pretty much on the precipice of new all-time highs? Is because of this guy. Well, in reality, this is how we thought he was going to look going into the meeting. And then we realized after the meeting, Jerome Powell, the chairman of the Fed, has actually been hitting the gym, getting some tats, and he looks a little bit more like that. Now, obviously, jokes aside, clearly at 10 a.m., something changed, and something very much did change. He was speaking at the Jackson Hole Symposium, giving us an idea of what the next steps of monetary policy are going to be, and it was pretty evident. In the near term, risks to inflation are tilted to the upside and risk to employment to the downside. Baseline outlook and the shifting balances of risk may warrant adjusting our policy stance. So what does that mean in layman's terms? Well, it means in September, we're going to be getting a rate cut. Even though you could see this with the Fed watch tool, I actually find Polymarket to be a little bit more interesting. So going into the 10 a.m. announcement, there's actually a 40% chance of no Fed cut in September at all. And then as soon as we got that announcement from Jerome Powell, boom, it plummeted to 13, and then over the weekend kind of settling at 20. So here's the major TLDR, the main takeaway. Going into Friday, the market was pretty uncertain. And remember, markets hate uncertainty. It was uncertain about the fact of the rate cut. Are we going to get one? Or if we do get one, how big is it going to be? But there were pretty clear odds, a good statistical chance of no rate cut whatsoever. And then based on the commentary from Jerome Powell, the chairman of the Fed, the guy kind of leading monetary policy at the Jackson Hole Symposium, well, well, became pretty evident that in fact, we are going to be getting a rate cut. At least the odds of it are high. Obviously, nothing is guaranteed. There's going to be a lot more reports coming out between now and the September meeting. But right now, it seems as if they are kind of open to this concept. They are willing to do a rate cut as long as we don't get some really bad numbers. And when I say really bad numbers, I'm talking about solid jobs numbers and also high inflation. If we got that, we might be going back to the chance of no rate cut. But on the flip side, if inflation is constant or coming down, and if the labor market is constant or worsening, well, then the chance of a rate cut is actually going to probably go up and up and up, not just for the September meeting, but also for the following two meetings to really round out the year in October and December. Now, I know that's some pretty boring monetary policy talk, so let's talk about what actually happened throughout the day. Clearly, the market exploded at 10 a.m., and then kind of for the remainder of the day, we just went a little up, a little down, a little up, and really nothing. The major move was pretty much done by 10:30. So how did that look underneath, under the hood? Well, big players, this is kind of how much aggression is going on in the entire New York Stock Exchange. You can see a lot of aggressive buying pretty much around till 2 p.m. And then they kind of said, all right, time to go to the Hamptons for the weekend, something like that. With respect to options, you can see that this is the delta movement for the S&P 500, not as strong as you might think. If anything, we kind of just chopped up, chopped down, a little bit more down than anything else, even though the market was looking so good. Similar situation in the NASDAQ, but then this was wildly different than the specific to the Mag 7, the grouping of the most influential 7 tech plays. They actually ripped all day. So the overall indices really choppy, slightly down, but then the Mag 7 absurdly strong as it relates to the action in the options market. All right, now that you understand a little bit more of the narrative, and then we obviously also jumped into the numbers to see that there was a decent amount of buying, but maybe not as strong as you thought it would be, the golden question is what's coming next? And my answer is going to be a little bit bittersweet. So the sweet part is, yes, I very much believe we're about to hit a new all-time high, and I think we're going to go higher and higher and higher. But the bitter part is I think that this is actually going to happen quite a bit because of higher inflation. I believe we're about to see a pretty large appreciation of a lot of assets, which is good if you have assets, but on the other side, if you have your money in cash on a relative basis, I think it's going to lose quite a bit of purchasing power. So I don't think that the markets are necessarily going to be going up and up and up, but on a relative basis to a devalued dollar, I think it's going to appear that way. So once again, I think people who own assets, whether it's crypto or equities or even something like a home, are going to do well, and people sitting in cash are probably going to be left behind. In case you don't realize what's happening, the Fed is about to start cutting rates into stagflation. This means rate cuts into rising inflation with a weakening labor market. If you don't own assets, you will be left in the dust. This is a true statement, if you will, because really we're going to see markets go up and up and up on a relative basis as the dollar continues to lose its purchasing power. So basically, don't sit in cash if you believe, like me, that this will most likely come to fruition, which kind of begs the question of, can this actually happen? Without a doubt. Rising risk for U.S. economy, a job market that's just meh. Employers are holding on to workers, but hiring has slowed, creating a fragile labor market. So the market should be helped out a little bit when the Fed starts to cut rates. But remember, that's not going to be helping with inflation. If anything, inflation is going to probably keep going up from here, and we never really hit that 2% target. So once again, just to drive the point home, I deeply believe asset prices are about to skyrocket, really continue skyrocketing. But the reasoning for that is not necessarily optimistic. I think it's because we still have to deal with inflation. So the dollar is going to lose a lot of its purchasing power. Clearly, that's a bit of a medium-term call out the next couple months, the next couple quarters. For those of you interested in the upcoming week, we have a lot going down. On the screen now are all the major macroeconomic events. I'll be paying attention to the goods orders and consumer confidence on Tuesday. GDP and the initial jobless claims on Thursdays are going to be very important. And then obviously the most important thing of the upcoming week is the PCE inflation report. This is going to be massively important. You have to pay attention to that. We also have one major earnings by the name of NVIDIA. So obviously between the inflation report and NVIDIA, expect quite a bit of volatility this upcoming week. The NVIDIA one's going to be very, very impactful. NVIDIA earnings are the stock market risk event after the Fed rally. Allegedly, they have an announcement coming out on Monday, and then the earnings are actually on Wednesday. If they crush it, yes, I am fully expecting a continuation of new all-time highs. If they miss, this little pop we got on Friday might quickly disappear. So obviously it's a binary event. Please pay attention to it. And then don't forget the other binary event is the inflation report on Friday. We are in a situation where it could be a mixed bag. It's a little up, a little down. They both could be bad and we could absolutely plummet. They both could be good. And I'm not just talking about new all-time highs. We could see a nice pump above the current all-time high level. And as a quick side note, even though it doesn't have earnings, it does impact tech and semiconductors and what's going on with the trade war. I just wanted to bring this up because it's somewhat of a related company. U.S. government takes a 10% stake in Intel as Trump expands control over the private sector. Now, with this, we were kind of covering it a little bit, but we didn't know if it was actually going to happen. Well, it's now being reported that it is a done deal, and I would love to hear from you in a comment below. Do you believe the U.S. government getting involved with private companies is a good thing, or do you think it's an absolutely horrible thing, or do you not care about it at all? And before I let you go, if you haven't already, don't forget to sign up for the newsletter, macros.locals.com. It's 100% free, has always been free, always will be free. Every single Sunday to your email inbox, I break down what's going on in the market, cheat sheet for all the earnings. I highlight the one that I think you're going to care about the most. I have all the major macroeconomic events that you should be paying attention to, and then the seasonality for each trading day. Monday is bullish, Tuesday is bullish, Wednesday is leaning bullish, Thursday is neutral, and Friday is neutral, but recently a little bit more of a pop. So overall, the final week of August favoring the bulls slightly more than the bears. That's what I have for you. I appreciate the good vibes. If you have any questions, comments, or concerns, let me know in a comment below, and I'll do my best to get back to all of you. I hope you had a great weekend. I'll catch you in the live stream tomorrow morning, 9 a.m. bright and early. I'll see you there.